For those that have seen it before, so be it. I'm just gonna talk over the coffee mug. So, what I think is important, if you didn't watch the webinar about 2 weeks ago, we actually did a live webinar with Clem Santa. So I'm really not going to waste your time today and go through everything that he said 2 weeks ago. It is on YouTube, so go and check it out. I found it fascinating because Clem is actually more positive about South Africa than he was a year ago, which I can safely say I didn't expect, which is why he does the scenario planning and not me. Is that fair? So do you mind if I just put this water here? So what's really important is that for me, Clem Santa is one of the most recognized people in South Africa. He was the ex-chairman of Anglo Gold. I don't know if it was Oxford or Cambridge, but it doesn't really matter. And he was also part of CODESA, that whole thing with Nelson Mandela. And he is literally respected all over the world for his scenario planning. So what that basically means is that he doesn't know the future any better or worse than you do. But what he does is that him and his partner, this lady, Chantal Ilbery, they choose, they come up with different scenarios for the world. And then they have basically a flag system. So, which, if you're in Cape Town, you guys are all in Cape Town, so hopefully you all know this. If you don't, this would be a moment to understand this. When I do this in Joburg, I kind of help them save their lives when they come down to Cape Town. But if this flag comes up, and you're in the water in Muizenberg, it's probably quite a good chance to get out the water because there's a great white coming. So that all that Clem Santa does is that they give you scenarios, and then they have flags to watch out for. Does that make sense? So again, what I would recommend is go and watch the webinar literally from 2 weeks ago, because he's got 4 scenarios for the globe. And it's really important to know where the global economy is going if you're going to try and make the right investment decisions for yourself. And secondly, he's got 3 scenarios for South Africa and where South Africa is going. And equally, you should be able to make your own decisions. Now, I sat back and I watched him for years. And then one year, I don't know why, but I thought, well, there's no point in me just listening to this. I want to create a model to be able to help me make better decisions based on his scenarios. So I created a 4-dimensional model, which I know is not normal, okay? And then for about a year, I didn't share it with them because I wasn't sure if it was any good. I'm not sure if anyone else in the room's ever built a spreadsheet and didn't know if it was any good, okay? But about a year later, I was with him at an event, and I just said to him, Clem, would you mind if I share this with you? I'm just interested in your opinion. And he's such a kind guy. If you ever get to meet him, he's one of the most wonderful people. And he literally the next day got back to me. And he said, Scott, this is really powerful. Like, you really need to share this with people. And so we went out, and I would rather run comrades back to back 3 times than write a book. Okay, because trust me, it's not that much fun. But when Clem Santa says, you need to get the book out and I'll endorse it for you, then you kind of have to take that opportunity. Okay, so the book came out in 2014. And really, a lot of what I'm not going to talk too much about it today because it's in here. And by the way, the book move at the same time. So you can look at different markets at the same time. When we did start investing in America in April 2012, we did a huge amount of work on the risk. So we looked at what does the bank debt mean? What happens, with America's bank debt? What happens if the dollar is no longer the world currency? We spent a lot of time. I mean, Henny spent a huge amount of research even looking into Obamacare and what impact that would have on the medical industry. So I've written a lot about that in the book, and again, trying to understand the risks. Again, for me, you start with the risk, and what did I say? What's the most important thing about risk? If you can manage the worst case scenario, then everything else is upside. Yeah? So for me, we started in that place. And I do just completely off the cuff. I didn't say this anywhere else. I don't know why, but I just thought of it now. I do also say to a lot of people, they say, what happens if the American economy crashes and the dollar's taken off the dollar and all the world markets crash? What do you think will happen? Yeah, well, it's interesting. Everyone has a different opinion. I tend to say to people, we don't have to really surmise it. We just have to look at what happened in Zimbabwe above us 15 years ago. Because really, you don't get much worse economic calamity. Massive inflation, the whole monetary system fell over. And what I find really interesting is that, the thing that held value was houses in US dollars. Office buildings didn't, because businesses go bankrupt. But it's really interesting to look at what happened in Zim and almost go, okay, well, that has to almost be a worst case scenario. No matter where we go in the world, do you see, again, looking at risk? So just spend some time if you want to looking at Zim. The other thing with America is you've got to be very careful. Outside of London, I lived in London for 9 years. Outside of London, I know there's a lot of people here selling houses up in the north of England. I've owned properties there. Does anyone know the difference between a paper yield and a real yield? Anyone? Paper yield is what a salesman sells you. It looks really nice. 14% return, cheapy little property in the north of England, 14% return. A real yield is what the money you get in your bank account. Because after the maintenance, the house burning down, the skinheads knocking your doors down, I've done it. I'm not talking about someone else. I've done it myself. We had 3 of them. So be very careful between a paper return and a real return. There's a reason that generally very cheap areas have higher yields. And I've learned from experience it's not necessarily because it means you're going to make a lot of money. Australia is a fascinating one. So a lot of people want to immigrate to Australia. Buying property there can help you immigrate. But I think what's interesting for me with Australia is it's also a very small market. I mean, there's literally like 6 or 7 cities. And we had an interesting story in Australia where we basically bought a shopping center in about 2010, I think it was. When I say we, I was helping Henny. I was just on the trip, if that makes sense. And they, so it's probably better I use the word they were buying a shopping center. And there was a guy that bought the shopping center for $32 million before the crash. He then had a mortgage with, funny enough, Investec Bank for $24 million. And we put a cheeky offer in for $15 million. And what I found really interesting was that the Investec guy should have gone on a negotiating course because he accepted it immediately, which meant we were like, oh shit, what's wrong here? And we went and did quite a bit more DD, and we ended up not investing in that building. But what was interesting is that we found out a year later that there was a guy that I met that had seen that building more than a year before we saw the building. So my synopsis in Australia is that there's an old boys club there. Sorry, ladies, but it's true. And sorry, South Africans, I don't care how much money you've got, whatever comes this way has been turned down by the Australians. So there's only 2 options. You either accept that you're taking second best or you partner with one of the old boys. I'm dead serious. Like in terms of, so the Aussie market is a good market, but you've got to be in the old boys club. And then lastly, South Africa. I'm not going to go into this in a huge amount of detail. Obviously, as you all know, there's been tremendous growth in this part of Cape Town. I mean, the numbers are actually astounding in terms of what's happened in the last 3-4 years. And I think everyone in this room probably understands. I tend to find in Cape Town, people are very similar to people in England. There's only 2 types of people. Those that are pissed off they didn't buy property, and those that are pissed off they didn't buy more property. So, I don't know. It does worry me. I know in Cape Town there's a huge amount of people immigrating to Cape Town, but please always remember the fundamentals. Prices don't go up forever. So people always have to, when risk and reward and income is, but we'll talk about that a little bit later. So that really brought us to GIDS. GIDS started off with the Global Wealth Index, which, for me, going on a family holiday to Disney World, being able to go skiing in France, sending your kid to a private school in Australia, going to Harvard, and or immigrating, for me is a sign of a global citizen. And whether you live in South Africa or Singapore, it allows you to then determine whether you can do it. This is pretty important. I'm not going to waste too much time on this because we'll put the links up on that Facebook page. But if I go there, hang on, let me just share my screen. So this is all the stuff that I put in that book. And why this is important, what are you seeing there now? You should be seeing my PowerPoint, no? So, okay. So this is quite, for me, is really interesting. So a lot of people make decisions based on gut feel. And my request to you is don't make decisions based on gut feel, make it based on research. So this is from The Economist. It's the best research I've found anywhere in the world for residential. It goes back as far as any research goes in all the major markets. And if you take Australia, England, South Africa, and America, you would actually look here, you would more sense when it comes to income. Then you've got England and Australia, and then percentage change. Okay, so you can do that for cities. So just as a matter of interest, if you take America, rather than having a gut feel, you can take Atlanta, Dallas, New York, and San Francisco. So you can see down the bottom here, you've got Dallas, then you've got Atlanta, the blue one is San Francisco, and the yellow one is New York. If you take prices in real terms, price to income, price to rent, the percentage change. And if you want to do the same with England, you can do exactly the same thing. So you can see the different markets in England, and you can play around. If you want to get the best information for UK properties, I'd highly recommend you don't do anything in England unless you go to Academimetrics. They were Academimetrics, they now call themselves Acadata. If you want the best in Australia, it's CoreLogic. The best in America is S&P. The best in ABSA. This one's hilarious. Does anyone work at ABSA or work in the digital department of ABSA? Okay, so yeah. I don't know what I'd do if you put your hand up. But anyway, my point being is that so ABSA has the best research. I haven't bought a house in South Africa since 2010. And so I tried to look last week, and I went to their search bar, and I put in research, and it said no results. It's quite interesting. So my point there for ABSA is that they do have the best research. I just have no idea where you're supposed to find it. Then we literally put that all into a 4-dimensional model. It helped us then decide where to invest. So America for us is still sitting in the high return, low risk. You've got Australia, the UK, you can see the rest. You've got the entire fundamentals. So again, I believe that the world changes. I believe technology enhances things, but I don't believe the fundamentals of investing and or business change dramatically. So you've got fundamentals. So again, rather than using gut feel, you just really put in the facts, and it gives you ratings. So that's the risk side, and then on the return side, you've got the yield, and we take a 70% weighting. And in the beginning, it was Jaco and myself and Michiel and Henny, and we were doing this stuff to do our due diligence. Willie joined with his investment banking background, and he really came along and built GIDS 2.0. And just before I bring him up, I just wanted to show you, for me, again, we've been investing in all 3 markets, and you can actually see when we got into markets, when we got out of markets. And I fundamentally believe that if you get it right in one market, you fluke it. If you get it right in 2 markets, maybe. But if you get it right in 3 markets, you're starting to do something right. So is it the all-knowing? Definitely not. But I tell you what, if you've got systems, you have a better chance of success. Yes? Yeah? So the other thing that I thought I'd just share with you before Willie joins us is that I did the research about 6 to 12 months ago. I can't remember. So I know the rand's recovered a bit, so you can take that off a little bit if you want. But basically, if you took a South African house and an American house as far back as 1978, which is as far back as the research goes, you'd be 424% better off if you invested in America. If you'd invested in, what's that one? Australia, 499. And if you'd, what the hell's gone wrong with this clicker? If you invest in the UK, it was 332. So what I find absolutely fascinating is the question I will ask you is if you could go back to 1978 and you could kind of invest in a basket of goods, would you, knowing that, at least diversify across a couple of markets? Yeah? And again, I learned this from Hunt Australia. One of the easiest ways to predict the future is to go back in research and then see. Now, it's not a guarantee, but it's better than having a gut feel. Okay, so this brings me, to Willie, and really what he's going to take you through is all the different parts. So looking at the stability and the expected income. So in America, I learned a really interesting lesson about 3 years ago. Do you know in America, I can buy a some people in the room that are going to salivate at the mouth with the detail. Okay, absolutely love it. Okay, and there's some people in the room that are like me that quite frankly doesn't care how my engine or my car works. I just want to go from A to B fast. Okay, so the point is we're going to put the next half an hour aside and Willie's going to go into the detail because you know what we've done to date? We've just assumed that you guys all knew that what we were doing behind the scenes. And we actually realized that people didn't know. So we thought it was really valuable for Willie to share because we had GIDS 1.0, which is what I've shared. He, over the last year, has built GIDS 2.0, which is our sophisticated modeling behind the DD. And today's just the start. For those people that salivate with the detail, you'll have access to all of it. Is that fair? And for the rest of you that are like me and you just go, Willie, if you say thumbs up, I'm in, that's also good for you as well. Does that make sense? So over to you, Willie. Thanks, mate.
All right, thanks. Okay, so let me just pause there for 1 second. My name is Willie Olofse. I'm originally from the Free State. And I've been in the financial markets for over 18 years. Most of it has been at ABSA as a credit analyst or some sort of analyst. I went to JP Morgan, as Scott mentioned, an investment, which is an investment bank in London, worked there for 3 years, and was an MIS analyst there. So one of my, to some extent, want to call it a hobby, is building things and models in particular. So for me, it's great fun in building these models, and that's one of the things that I've done when I was at ABSA, and at the same with the time at JP Morgan. Interesting enough, the department that I worked at was the exotics and hybrids. I was the MIS analyst, and it was the department which did all the CDOs and all the interesting subprime mortgages and sold them on, So if you saw the Big Short film, I was one of the guys that tracked that information, and it was quite a investing overseas, this is the type of money that you have to put aside to really look into those numbers. So why am I using all of them? Why can't I just use Reese? The reality of it is that each of them has got their own opinion on particular markets. Some of them do track like Reese, the minor details. So what has happened in a particular area, let's for instance say Atlanta. Atlanta is a metro in Georgia, which is made up about many different suburbs. Now, Atlanta as a whole might be performing quite well, but the suburb where you are planning on buying that building might not be working that well. Why? As we see in urban progression, as that things are now moving back to the CBD in some countries because of the millennials coming in and they want everything to be together. Where the older generation, they want it not to work and play together. But the millennials, they want to do everything at the same space. So effectively, suburbs are changing. And that's the type of things that you need to take in consideration, is that things will change. So that's why we use numerous of reports. Essentially, what has happened is that Scott already made mention to that there's particular interactions that takes place with regards to calculating things. So I've changed the model to be more efficient relating to evaluating commercial property, because like Dr. Dolph Therese, he's a specialist in the residential space, so I took some of that metrics that he uses there, because some of it is still applicable on commercial. And it's all been grouped into a new evaluation tool that I'll give you some privy to just now. So essentially, we want to track a bit more matrix. Scott has already made mention to interest cover ratio, debt cover ratio, the internal rate. By the time you actually got everyone involved in buying the asset, it's gone. So essentially the process is as follows in the US particularly, is where you get the opportunity, so you get the chance to evaluate it. So essentially the first step is we evaluate it on a high level by checking the macro and micro environment. So is this figures that they are providing us in relation to what's happening in the market? So for instance, when they say, tell us that the selling price is 10 million, How did they get to that number? If we compare it into the market space, what's the capitalization rate versus the net operating income? So if we reverse calculate that, we can establish what should be the value. So essentially, if you look at Medical 8, which we are launching pretty soon, you'll note that the capitalization of purchase that the guys share. So at the end of the year, if they have paid not enough, we charge them extra. If they've paid more than enough, we give them back if there's a surplus. So at the end of the day, we can more accurately establish what will be your income and the expenses to that. And essentially on the high-level due diligence, we check that, what's going in the market. That's why we take the reports into place. So essentially what we want to make sure is that information that we've got there is now going into GITS 3.0, because we want to bring in artificial intelligence, because essentially what you'll find if you stay on for Willem is that there's an emotional attachment that can happen that can cause you to probably not consider something that is actually performing well. So we want to take all that information, do it, give them a weighted ratio, which we can establish and make sure it all can be tested. So it's still in progress, so that's why it's planned. But that's essentially what we want to get to, is we're a space that we've got partners from all over the globe plugging in their information and making sure that the turnaround time is quicker and we can move it and get it all done. So that's where we want to progress towards, is making sure that we are able to provide a trust environment, and that's the purpose why I'm here, and I hope by the time I'm done that you guys can understand that we want to make sure that we are transparent. So all the information is actually there. So if you wanted to look into Medical 7, which we've closed this week, and Cypress Reach, we've got all that of it, we can make it available for you. So there's going to be a report that you'll see now going forward from all the products that we will and opportunities that we will launch in the near future. You can note there, I don't know if the guys at the back will see it, but this is sort of what happens with the high-level due diligence. You send through the letter of intent, and then the seller needs to give you all these reports. That's what you pre-agree on. So what essentially happens, there's third-party reports, which I'll show you now, which is basically the banks requiring it. So they want to know what is the maintenance required for this building? How long will this building still be effective? So if we look at Medical 7, it was built in 1967, which meant that there was it's an old building. Now, one of our criteria at Migrate, which the investment committee set aside, is that we don't necessarily want to invest in a building that's older than 10 years, unless we can add value to it. For instance, with the multifamilies that we've got a scenario where the partner is a specialist in purchasing vintage buildings, which is built in 1980, renovating them, ensuring that they change the appliances and make sure that there's different type of amenities added to that particular building, which will draw a new type of tenant into it that is willing to pay a bit more. Essentially increasing your income over that investment period of around 4 years. And at the end of the day, because it's a multifamily, which is like an estate, and the multifamily is a different asset class, and Scott will just touch on it after I'm done. Yeah.
Just explain it, because I think there might be people that don't know what multifamily is.
Sure.
So we, in South Africa, talk about it as apartments, if that makes sense. And in America, what's quite common here is that a developer will build a building and then they'll sell off all the apartments, all individually.
Which countries we want to be in, and drilling down to the space where are in an upward cycle. We know it now from a downgrading in South Africa, but in the US and globally, we'll probably see interest rates growing up. So for that reason, we need to mitigate the risk. So we go to the investment committee just before the Trump election. Well, I call it the Trump election, before Trump was elected. There was a slim chance of him coming in. A lot of people, I'm sure half of the audience probably would have not guessed that Trump would have become president because it didn't make sense at that time. But what if that happened? So at that stage, before we launched Medical 7, we were already in the negotiation phase with the building. We got it on the contract, and we were planning on launching it in January. But before, in November, we need to, at an investment committee level, decided and take a view as to what will happen. And if that happens, how do we mitigate it? So essentially, at that period of time, the interest rates were 4.25%. When we closed the transaction, it was closer to 5.1%. So I accounted for, coming from the banking environment, coming from ABSA, being a conservative bank as it is, I try to build in some flesh and make sure that we can accurately project the fees. The cash on cash or return on investment that you're going to get. So let's just quickly touch on, I've still got good time. I'm impressed today. So this is the property condition assessment report that I've just talked about. So I'm going to try and scroll through here. Let me just do this. On the side, let me make this a bit bigger. So these are projections over here, and where the specialists, and that's just to notice that oh my word. You've got too many things open. So then we've got an environmental assessment report. How older the building is, there's a risk of asbestos. For instance, now with Medical 7, we had to debate that as to what implications will it have on the investor. Will you as investor need to pay additional amount of capital if for some reason there was a water leakage, and now they realize that there's asbestos in the building, and now we need to replace all the tiles, or what effect will it have on you, and you have to pay in again. So essentially what the environmental assessment report does for us is we make sure that we don't have unforeseen aspects that can happen. So they look in the area, is there now a plant that gone up since the building has been developed that can influence the water or cause you as an investor to pay in additional cash. So we look through this report. It's also, I think it's, let me just check here, I can't remember now, but it's, as you can see, quite substantial, 209 pages. That we have to look, not have to, but we want to look through to make sure that we don't miss anything. So what happens with the asbestos now, just to to give you some peace of mind, is that in the US, you have to pay $1,000, and then they make a health, health safety plan that needs to be implemented if we do any renovations on the building to ensure that the workers or anyone in the building but during that period of time is not exposed to asbestos. So the other report that is also important is the zoning report. The reason why that is important is that we are assured that when we purchase the building, it is the building that we're buying, and it is zoned appropriately, that there hasn't been sort of under the table things done where someone got input sheet. As you can see, I'm making provision for a portfolio of buildings. So if for instance, with Medical 1, we had almost 6 buildings. So each building is operating on its own, but you group it together, then you want to know what's the outcome, because one might be having a bit of a vacancy, and the others might be fully leased. So you want to know what's the average out, and what will you gain from it. So essentially, this is the input sheet that we are growing into a space where we want to add it to the website, and where each partner can plug in these details, and the outcome will be automatically generated through this mechanics that's here. So it's just pure maths. It's not that difficult. So essentially, there's a couple of things that needs to take place. We're taking all the assumptions. For instance, in the US, you've got the inflation rate is currently at 1.8%. We are forecasting at 3%, and that's also one thing that how we can not guarantee, but more accurately establish what your return will be, because I can assume that in the lease agreement it is stated that we are escalating at the 3% over that period of term. Some leases might not be that, and we also make provision for that in the model to on a different basis account for that, so that we can get to a more accurate number. So what is important as well is that, like I mentioned earlier, I'm of the view that we are in an upcycle. The Fed has already indicated that they want to increase the interest rates. I think next month, or not. I think in 2 weeks' time, they're sitting again. And if you're a gambler, the bookies state that about 80% chance that the interest rate will go up in the US. So that's the type of risk that you want to we decided last year, because of the risk, the political risk in the US, that we move from a 70% closer to a 50-55% on loan to value of a property, just to mitigate that capital call risk, because at the end of the day, you don't want to actually pay any additional just to get a small percentage of income during the period of time. So as you can see, as we make provisions for the exit in this, and then Scott will touch on what is the costs or the fees that we generate. So as you can see, there's a due diligence fee that we account for, and there's various closing costs. You know, if you look at the brochure, there's always a scenario where there's only a closing cost figure. Now, I don't want to show you all these numbers, so we just group it together. So, but it's all available. We want to be transparent, and you are more than willing to ask for these numbers, and we can make it available. So essentially what happens is that I've got different tenants. Now, why do we like the medical office blocks? The doctor doesn't leave that often. If you consider your GP, he's probably been in his practice now for the number of times he's been in business. Why? Because it's demographics related. He's built up a relationship with the area, and he's usually in there. So what ends up happening, and what we like to see, is that the terms are usually in the region of 10 years, 5 to 10 years. And in this particular, this is actually medical 8 that I've touched on. There's about 8 years still left, which means if we've got an investment period of 5 years or outlook, there's still some room to sell it on to someone with the contracts in place. Given that it's a medical office block, the chances of them renewing it is usually quite good. So I'm almost complete. So I'm just going to touch on So we're not exponentially changing the numbers, just to be clear on it. The reason for it is that Medical 4, we started the whole process. We've done the purchase and sales agreement. But then when we looked into the deeper details, we realized that the tenant's balance sheet is actually not strong enough to support the lease over the long term. So we look into those details to ensure that at the end of the day, that as Scott has mentioned, that the tenant is not going to disappear because of financial reasons. Something exponential, which Willem will touch on, might. But in essence, for the next close to 5 years view that we take on the particular building, debated by the investment committee, we are happy that we've mitigated most of the risks. So I'm here all day. If there's any questions that you want to delve into more, I just wanted to give you guys just a better idea as to what we're busy doing, where we want to progress, and what details do we go into. If there's anything that I've missed, please feel free to ask us. I'm more than willing to help. Trust and transparency is what we stand for. And if I can assist in doing that, it's my privilege. All right.
Thanks, Willie. Appreciate it. So just my interest, who here in the room would like to get access to all those reports, the models, and everything else. Sponges? About half the room. Okay. You know what I love most about life? You have different people that like doing different things. Because if I had to look at 400 pages and put it into spreadsheets, I would play Russian roulette with a machine gun. We all get to do what we love. But brokers just bring them to us. So every one of them had a story. This one here, is this the first one? Yeah. The first one was like, I can't remember the exact number, it was 6 or 7 doctors, 3 or 4 of them were retiring. The 3 or 4 that weren't, they couldn't agree the value, so they agreed to sell the building. Okay, and because Paul's been, who's our partner on the ground in Atlanta, has been in the industry for 20 plus years, he gets these calls off market before they're even on the open market. What was fascinating is that building was, I think 11 or 12% not let. And it was really interesting because the doctors were trying to save money. So the way they were trying to solve their problem was they had a little sign outside, call us if you want a tenant. They thought they would save money by not getting a broker, but then they had vacancy of 11%. Paul filled that space before we even moved into the building. Like before we even owned the building, it was full. Now that's adding value straight away. Does that make sense? This building here was, this guy's financial advisor came along to him and said, you're too heavy in property. I know you've owned the building. We highly recommend you sell the building, take your money, put it in the stock market, but sign a nice long-term lease. He's a plastic surgeon. He's had a practice for more than 20 years. But if you want to really look at all our mistakes, I actually wrote an entire chapter on it. It's chapter 3. And the book came out in 2014, so we probably need chapter 14, which would be the mistakes over the last 3 years as well. Yep.
It makes sense if you're talking about social proofing to actually have a page up with all the closed or the finalized investment with with the projections and the actuals, and even those that didn't work out, because a lot of people think it looks too good to be true.
Yep.
So if I want to send a skeptic to a page, that page, even with those that didn't do well, will actually convince me more than anything I can say.
Just as a matter of interest, where's that microphone gone? Yako, are you in the room? Marketing team, are you in the room? Denise, you're in the room. Would you mind just repeating that for the camera and for them? No, I'm joking. No, but on a serious, so did you guys hear what he said there? So it's actually what we're wanting to do from a social proofing thing. I honestly believe that, and I'm sorry if this comes across as arrogant, but if you come to an event like this, you get to know who we are, you get to hear the ins and the outs, hopefully some authenticity to it. But I think if you go to our digital webpage right now, it doesn't reflect that. That's my honest truth. So, yeah, and I appreciate that. And we recognize that as well. In fact, Sean's just joined the team so that we can try and take this experience live and digitize it. And that whole social proofing thing is one of the most important things. I completely agree with you. Just those 4 slides on track record, Willie did for us because the business day has been asking for it for, I don't know, a year or so. And when I saw that, I was like, why are we not telling the world about that? But but equally, it's on the bad side as well. Like, if stuff doesn't work, what's being done to fix it? So, completely agree. Okay, just in terms of I'm just watching the time. In terms of the different areas, so something that I realized that I made a mistake, or in terms of where we were making a mistake as well, was that people hear the whole of America. It's a pretty big place. So as you probably heard from Willie, we're actually not in all the markets. Like, we're in literally 4 or 5 markets that we've focused on. And equally in sectors, we're not in all the sectors. We're just in sectors we like. So one of them that we like is medical. I know Willie mentioned it, but I want to tell a personal story because I think it makes it more real. It was 2009. I was in Bondi Beach in Australia, and I was there when I met Henny and Peter. And I remember sitting with Henny. I had not only invested in quite a few houses myself, and I'd met quite a few, well, I'd helped a lot of other people buy houses. I remember sitting with Henny and Peter in 2009. I was like, why do you do medical buildings? And I remember Henny turning to me and going, well, it's pretty simple. I've been doing it since '92, and there's 3 reasons I do it. One is, no matter what happens in the economy, people need doctors. I'm like, okay. Now, remember, we were going through a massive crash, and it was like, okay, that's pretty interesting. Second one, doctors never leave. So what's quite interesting is that if you think even back to when you were a kid, there's quite a good chance that the medical premises are still there. I'm unfortunately old enough that my doctor's passed away, but the premises are still there, okay? But I'm serious. And the third thing is that doctors are also very good at being doctors, but they're not accountants. So they tend to sign pretty favorable long-term leases. game are changing. The multifamily sector, and a number of people would be flying in there. We'd be going to try to look at deals, Michiel as well. And two problems. One is we'd go and find this like 250 units in Orlando. And they're in a sort of a state that needs to be repaired and then managed. And we're like, this is going to be a challenge to manage this from Joburg. Do you agree with me on that? And the second thing is that because all the institutions really liked the deal and the family offices and the whatever, they started really heavily investing. So we couldn't find deals that made sense. And we made a bad mistake, which was, again, we tried to invest in property, but what are we supposed to invest in? People. So we changed our strategy, and it was only last year sometime, I know Michiel and the team worked on this particular guy for over a year, that we managed to build a relationship with the PPA group, Monty. And, as an example, when we did Cyprus, which was our first multifamily, there were 20 offers on the table, 20 other people bidding for the same building. And we weren't the most expensive. Like, we didn't pay the most money for the deal, but we got it. And when I say we, quite frankly, I didn't get it, you didn't get it, no one in South Africa got it, Monty got it. We just got to partner with Monty because of his track record. So he's been in the market for 20-odd years. He's got over 4,000 properties under management himself. So he gets deals because he's got a good reputation for closing. Do you see the logic? Hopefully it's starting to kind of sink in a little bit. The third one is self-storage. I think everyone knows self-storage in Cape Town probably makes sense. So this one, we spoke a bit about citizenship. I'm not going to spend a huge amount of time on it. Suffice to say two things. One is that we've looked all over the world. In fact, chapter 10 of my book is I looked at 16 different markets. So Malta, Cyprus, Mauritius, Portugal, Australia, America. Where else do people invest to get a passport? Italy. Okay, I haven't heard that one before. Anyway, I think where? Canada. Fair enough. So there's lots of different places. I think the one thing I'll say is, other than this particular EB5 program we found, every single place, in my opinion, and it's only my opinion, it's like my boat at home. Every day I look at my boat, I try and persuade myself it's an investment. But let's be frank, it's a lot of fun, and it costs lots of money, and it's not an investment. Is that fair? So for me, when I say, when you're going to Portugal or Cyprus or Mauritius or wherever else, and you're buying a passport, I have no problem with you buying a passport. But it's like my boat. Don't try and kid yourself you're getting a good deal at the same time. Is that fair? No, I'm not saying it's right or wrong. I'm just saying be realistic. Because if a country is giving away passports if you buy a house, why? Do you see, it just doesn't make sense fundamentally. I mean, the Portuguese Prime reading this, they reckon it's, if you can save 1% in fees, it equals about 10 years of retirement income. So, I find that pretty interesting because some of us, 2, 3, what difference does it make? Only 10 years of your retirement income. The other thing that I find fascinating is that, again, don't shoot the messenger, but according to all the research they did, when they looked at the fund managers, 96% of fund managers didn't beat the market over a 15-year period. So what's really interesting today is that you might have noticed neither Willie nor myself at any point have tried to sell you a fund. Why? Because we're not any cleverer than you. And we don't see the point of charging you fees to manage your money, to make investments, to underperform the market. Why don't you just invest in the properties yourself and outperform the market yourself and not have the fees? Do you see the logic, just in terms of the process? I know it's a fundamental mindset shift for half of you in the room, and the other half don't know what I'm talking about. But I don't mean that in a bad way. I really mean it. I truly believe that the future is about us looking after ourselves. And the stats prove that others can't do it better than us. The difference between a REIT and a fund, so I don't know if this is here because that thing crashed a little bit earlier. Yeah, I know. Oh, it's not up yet. It's not coming up. I'll tell you what, where's it gone now?
So Scott, while you're looking at the difference, in terms of the difference between a fund and a REIT, one of the questions here on Slido is, how does crowdfunding a property actually work? Is it possible? That sort of does also tie in to what you want to show here around
Yep.
funds and REITs versus...
So I literally want to just get... Sorry, when it crashed earlier, it closed all the Microsoft products. Oh, how's it gone? There it is. Yeah. Okay, so this is a work in progress. You guys are literally seeing this. It's still in beta mode, if you want to call it that. Okay, there it is. So there's an organization out there called Upwork, which if you haven't used, I suggest you go and check them out. Basically, you can find experts around the world to do research for you if you're too lazy to do it yourself, like I am. And the point being is that often they know a lot more than you do. So what you do is you can set up the parameters. So we asked this gentleman 2 weeks ago to do a full report on the difference between REITs and crowdfunding, so pretty much in line with your Slido question. I can share this with everyone, although in about a week it'll be actually completely finished. And so I'll share it with you in a week's time. But what we've done, I actually created these tables. So I don't have all the research. I created the tables and asked him to fill in all the details. But as you can see, it's a work in progress between the REITs and the funds. I think in simple terms, though, I get asked this a lot, and generally by very intelligent people. They ask me, people that understand REITs. So I explained to you already this morning that for me, firstly, a REIT has a 70% correlation with the stock market. So when you invest in a REIT, it's a blended fund. It's a fund, so you invest in a fund that's blended across multiple properties. So you might have a great asset, let's just call it Cavendish Shopping Centre, but you might also have a few weak assets, and they're all in the same bucket. Is that fair? Then also you've got liquidity, which is why people like it. It's on the stock market, but that's where the correlation comes in. It's a 70% correlation plus to the stock market. So a lot of people will say that, at the end of the day, it's based on the underlying asset, which is real estate, which is correct, except for the fact that it correlates with the stock market. The third thing that is interesting, you can use fintech, you can use prop tech, When I caught that Uber, when I caught the yellow taxi and then the Uber, remember it had 4 wheels, an engine, a driver, and it went from A to B. So is there any real difference then between a yellow taxi and Uber? Well, is there? For you personally? I believe it's a fundamental difference. I think you've got convenience. I think you've got trust. I think you've got transparency. I think it's a lot cheaper. I think it's a lot more accessible. I mean, who here in the room had a private chauffeur? None of us. Most of us didn't. So for me, when I get asked that question all the time, well, what's the difference? I'm like, nothing. There's no difference between a yellow taxi or Uber either. Do you see what I mean? Like it's a fundamental mindset shift. Yes, just because both are cars doesn't make them the same. Does it make sense? So just quickly, the last thing I would say on this, and then I'll move on, is that the number one thing that I believe is the difference is the last word of our 3 core values. So our 3 core values are trust, transparency, and alignment. And it's the alignment part. So if we were going to get into business, myself and you were going to get into business earlier, and quite frankly, you want to work really hard for the next 20 years, and I want to go surfing. What are the chances of it succeeding? Very remote, okay? And are there any Hilton boys in the room? Oh, wait, there's one at the back. So this gentleman here wants to marry a Hilton boy. It's a joke. Simple terms. A couple get together, they want to get married. One wants to marry for love. One wants to marry for money. What are the chances of it succeeding? In Durban, they said hi. So the question is, it's alignment. It's actually something I learned from Henny. It's really such a common sense thing that everyone gets. But then the question is, why do we go and buy a building from an agent that makes their money in the commission up front, and we're trying to make a return in the long term? Interesting, eh? Secondly, if you look at a syndication, so I got asked in Johannesburg about ShareMax as an example. ShareMax was taking 26% off the front. So you invest 100 Rand, it was 26 Rand was being paid away in fees. Okay. Now what's interesting, were they, as a syndication, were they incentivized to do good deals or just to do deals? Do you see? Because it's all on the front. There was very little on the back. It was just do deals. If you take the average, and please understand, I had a great experience in Durban, because after I did this little part, someone came up to me and told me he was the founder of Redefine, which was a bit humbling. But the point is, if you take the average fund or REIT, how do they make money? Fee, but how? What are the fees based on? Percentage? So the number one thing that they measure everything upon is called AUM, assets under management. It's the number one. You talk to any, go talk to any of my UCT mates that are doing it. The number one thing that they talk about is AUM, like how many assets under management. Why? Because they earn one. So basically, you're incentivized to just grow the fund. Like, think about the big funds in this country. Why are they buying the medium-sized funds? Because they can't get access to good deals, so they're just buying up more inventory to get more assets under management. Does it make sense? Now, you as the investor are wanting to make a return long-term. They're not incentivized to make a return long-term. They're incentivized to hold a lot of assets under management. Do you see where I'm going with this? So for me, the fundamental difference between the three is that syndication is incentivized on the front end. Funds and REITs are incentivized for assets under management. And when we designed the system, call it technology and property, we literally just took technology and property, if you remember the analogy you and I used earlier, of if we buy a property, how would we do it and just use technology to make it more efficient? And if you and I were buying a property, you'd be really pissed off if I was making all the money on the front end. You'd equally be pissed off if I was just making money just managing the building, the assets, if that makes sense. But if I came to you and said, hey, dude, there's an awesome building down the road. Let's participate. I'll be part of it with you. And if we outperform the agreed return, can I have some of the upside? Generally, you'd be like, cool. So that's our entire model, is that we basically have a performance, like there's a hurdle rate, call it 8%, and then the first 8% is going to the investor, and then we only get like a performance fee after the hurdle rate's been achieved. And we partner with the partner on the ground with the same philosophy, so that again, we don't want the partner earning all the money on the front end. We want them earning money after the investors have made money. Do you see the logic? So it's not a fancy hyperbole or algorithm. It's a fundamental understanding. It's a difference of how the business works, and that's why alignment is such an important word. Does that make sense? Yeah. So I got asked a question, and I'm conscious of the time here. I get excited and talk too much, but I got asked a question just before the tea break, which I wanted to answer, because a lot of people, well, someone came up to me in the tea break and said, "Listen, I get it, but how do I get involved?" So I just want to spend the last 20 odd minutes just kind of going through that and explaining it. So a little bit about who we are and what we do. We believe that the currency of the new economy is trust. We believe that there's been a fundamental shift between the old way and the new way. So the old way was unnecessary middlemen, limited trust and transparency, slow and inefficient, and difficult to understand the investment contracts. You know why? Why does the returns report have to be 47 pages so that I miss the part on page 32 about the fees being earned by the directors? The new way, no middleman, increased trust, the marketplace delivers faster, cheaper, and better user experience, and just make it simple, user, and intuitive. You know, if we're making 10 rand, dollars, doesn't matter, income, and the costs are $1, hey, guess what? The return's 9. Do you know what I mean? The trust for me is a really interesting one. So, you know, the old way was, could I put an advert in front of carte blanche or after carte blanche? Because if I can do that, you should trust me. The new way is much more based on peer trust. You know, people, which is exactly what you said earlier, you know, people hearing from people.
Internet, right alongside high-profile investors, and earn the same returns and monthly dividends. We're using the internet and our technology to give everyone access to real estate investment opportunities you've never had access to before. By giving you access to global real estate investing, our goal is to empower 1 billion people by 2020 and close the wealth gap that currently exists. It's one we know we can achieve through something we already know works: crowdfunding. By using crowdfunding to fund real estate projects, you don't need to invest huge amounts of money to become a part owner of a project. It levels the playing field and helps developers start new projects. It's a win-win for everyone. And our experience is second to none. Clients have trusted us to facilitate investments of over $1.34 billion on 5 continents over 3 decades. We've published 19 books, including New York Times bestsellers. And then there's our technology, our secret sauce that helps you make smart investments. Now it's your time to grab this opportunity. Do it now with our trusted, secure real estate investment platform. Visit www.wealthmigrate.com to see what amazing opportunities are available right now.
So two things on that. You'll see that I already mentioned the crowdfunding part. Because a lot of people say, well, what's crowdfunding? It doesn't matter, guys. Crowdfunding, fintech, prop tech, whatever you want to call it, it's basically technology coming to real estate. Is that fair? The other thing that I think is quite important is that I know that we've printed in 2014 in America, and for you all know what I'm talking about. In the old days when you used to sell property, you used to have big property stands, and you looked all fancy, and there were about 20 people there, and you had fancy brochures and everything. And so we South Africans turned up in New York with a big fancy brochure and TVs and everything else. And the other guy stood on stage and he was like, guys, if you want to know about what we do, we're a platform, just go to the website.com. I was like, I literally wanted to hide because we had all the brochures and everything. So we do have it if people want to take it away. But honestly, the purpose was for people to be able to go to the platform and get the information. Just if you like to think that you're not the first and the only people, I think it's quite exciting now. We've got users from 90 countries. That's actually wrong. It went up yesterday to 22. So 22 different countries people have been investing now. We've had about $56 million go through the platform. We've had over 900 transactions. You can see that average of about 63,000 per transaction with about a 3% in terms of the project fee. The team is about 50 people, like I said. This is something I'm excited about. More than 70% of people that invest actually reinvest. So we must be doing something right. And we've distributed about just short of $3 million in income, so out of the properties basically. Last year we were named by KPMG in November in the Global FinTech Top 50. I do find it fascinating. We were the only company in the whole of Africa to be included in that list. But we South Africans aren't very good at celebrating. The experience of the team, I think what's important is that if Yaku and I, just to use the two of us as example, were very good programmers and could sit in a garage, do you think that we would get access to really good deals in South Africa, Australia, England, America? So we fundamentally believed that you had to build a balanced team, one that was good at technology and one that was good at property, real estate. Is that fair? Because you've got to have both sides of the fence. And that's really what's helped us get access to really good quality opportunities in the 4 different markets. I mentioned already, this. I'm just using the assets under management because it's the lingo people understand. But ultimately, we don't actually have these assets under management. It's just that we've got more than $100 million now of medical buildings, which is we're quite excited about it because it gets us over that threshold. And then the last thing is as well, anyone can put a nice PowerPoint together, but it's actually built from a platform. I'm not going to bore you with this because these are the different kind of areas and the different focuses in different areas. Something that I think has changed quite fundamentally even in the last month is that we really went out and tried to get a really high-powered board. So if you know private property, Justin Clark has been building private property since 1999, so very, very good in digital and marketplaces. Martin Freeman has done a number of businesses, including fintech. He came on an IPS buyers trip many years ago, then invested in the medical and subsequently joined us at the board. Paul Nadira is one of the most respected people in the world in the whole compliance space. Dr. Dolph DeRoos, on the international investing and education side. And then Henny and Peter are the two that Vilja was referring So for all of you that think it sounds too good to be true, I'll log in for you in front of you so that you know that I'm not going to a demo site. And I'm basically logging in now to my personal portfolio. So you're not looking at anyone else, you're looking at me. And so there are, my wife and I's kind of balanced portfolio between the 4 different continents. If you if you click here on the funded investments, you might notice the pictures were similar. If I was to click on any of the projects, I can go into the project, I can go into the project updates, I can download the latest project update in terms of where it is. So I don't know how fast the internet speed is here, but it should just open up. So, this was just my quarterly report, all the different financials. For those of you A-type personalities, you just want to read the highlights. You can actually pay. What's happening? Question? Oh. Is that money sitting in a customer bank account? No. It's offshore. It's an offshore bank account, yeah. In dollars. So when you transfer money to wallet, you use that right on the day? Yeah. So it's whatever. So if you invest in England and you're getting paid pounds, it's in pounds. If you're in America and it's dollars, it's dollars. If you're in Australia, we don't arbitrage currency. So when you invest, you move your money and it's the rate that day. Does that make sense? Yeah. We also use, Willem's going to talk about Bitcoin after lunch, and we've got BitPay. You should chat more about Bitcoin and like your whole overseas allowance and what you can do, because you can move money through Bitcoin, but you can now do that. So I'm not going to bore you this afternoon or this morning with that. You can also log in, for those of you who are wondering. You can literally see what you invested. You can see your fees. This is now, the platform's been integrated onto a listed exchange, so it's the Seychelles, which is one of the top 15 in the world. People say, why not the JSE or the London Stock Exchange? Because of cost. Like, we rather you actually have money in your bank account, not paying it all away in fees. I didn't actually mention earlier, the average REIT in America, does anyone know what the average REITs are paying, plus minus? 4 point? You're about right. It's about 4.5 to 5%. I showed you our buildings are doing more than 8%. What's the difference? Fees. It's fees. It's literally fees. Like, we're all buying the same stuff. So that you can see the fees. And for those of you that have never seen blockchain or have no idea what blockchain is, this is live blockchain. So Jaco and Cliff and the team built this so that people could actually see it. So what this actually is, if this completely freaks you out, is that this is actually your deed of sale. So in the old days, Villy and I are buying a house. I sell, there's 16 different middlemen. It goes, how long does it take in Cape Town at the moment to buy or sell a house? 3 months. in the future, computing power is only going to increase and it'll ultimately get to a couple of seconds. A little bit to a lot. So for me, why I'm showing you that is not because of the way it's going to change the world. Willem will do that later. I'm actually showing you that because you can trust the system. When you give us $10,000, you're not giving it to us. We never touch your money, and I'm not going to the Seychelles on holiday with it. And you can check it twice. You can check it on the listed exchange. You can go on Bloomberg if you want to and check it. And you can go on the blockchain and check it. It's quite important. Trust is quite a big thing, is it not? So there's 4 simple steps. You literally register online, you select an investment, you transact online, and then you manage your portfolio. And like I said, this is the part I like most because it's all in one place. Our business model is really simple, guys. You've got investors who want to get access to good opportunities. You've got people around the planet that are very good property people that want to get access to investors. They list it. We help them invest on the platform. It's literally that simple. In terms of this is all the stuff that you can read about if you want to. There's only 3 words I wanted to point out around our investment philosophy. It's trust, transparency, and alignment. I spoke about it earlier. This here is the whole 10 points. As an example, number 2, always go to the building. I don't know if it'll be like that forever, but right now there's not one building Wealth Migrate has helped you invest in or anyone else that one of our team from South Africa has not been to. Literally touched it to make sure it's really there. How we make money? Everyone always wants to know that. We're not running a charity. So there is a fixed fee up front, which is for the due diligence on the project. And it's completely transparent. So every project, it's not an average, like it's a fixed fee. You can see exactly what it is, like Willie showed you on the performer. Now just quickly, if we were not charging any fees up front, based on even all the research that you saw Willie show you, do you think there'd be a problem? There's costs. It's not coming to us. There's physical costs to do due diligence. And if we weren't doing due diligence, would we make mistakes? We probably still make mistakes because we're human, but that's the cost. I just want to be frank, you know what I mean, in terms of where it is. And then you've got the performance, which I've already explained on the back. And then really, that's it. There's not fees in the middle, fees on the side. There's not mortgage fees and buyer's fees and seller's fees and everything in between. Is that fair? This is for the people that really want to get into the detail, all the kind of the stuff that needs to happen, all the KYC, AML, all the kind of the lingo around investors. The same is for the compliance and all the stuff that happens on the real estate, and then there's a whole bunch on the marketplace. And again, I'm not going to go into the detail, but it's all little steps that we had to tick off, and it's why it took us 20 years. This here is the flow of capital. So again, you'll all have access to these slides. You can go check it out. But most importantly, you're sitting there. There's the property. It's how the money moves. It sits in the escrow account. We, as I said, never touch your money. And if the project didn't go ahead, it just goes back to you. The profits, how the profits go through to you, etc. It's the flow of funds. Okay. And then lastly, just around the opportunities. I think today I've spoken to you a lot. There's really only 2 types. You've got income and you've got growth. Okay? And then obviously you've got the different sectors which you can get to choose in. If you look at just some of the ones that we've got at the moment, we've got the residential tower in the center of Cape Town, which is a growth project. You've got Medical 8, which, I don't know, Willie, when it's going live. Next week. I know that they're doing all the DD at the moment, due diligence. Water Ridge is available. This is a multifamily in Texas. And then the stable income, I'm not going to talk too much about. It's something that we're just starting out on. But it's actually for people that want to be able to park cash and earn a return while they're waiting to kind of invest in a deal specifically. Okay, now just importantly, again, you've seen the type of returns. I'm a little bit worried about the 7 to 10. I should have changed our slide. It should be 7 to 8. And why? Because how much are our buildings paying? 8. So it's just literally the building paying the money. Does that make sense? Do you know what I mean? It's a direct one-to-one.
Scott, one of the questions we got is, why would you invest in 7 to 10, 7 to 8, if you can invest in 18.3?
Some people like liquidity, and this obviously is taking money and just putting it in different deals, but you don't get the capital growth here. You just get the income on the project.
And then another one, can you explain what the timeline is on the payouts in terms of the income products, income investments?
Every 3 months.
And then what happens practically on a growth investment say when it reaches the exit mark? How is that? What actually
Okay,
happens?
so let's just take this new development. I think everyone in Cape Town knows what a new development is. Stable income. We want to create liquid products for certain people. But please understand, the more liquid you get, the more you're going to tie it to the stock market and sentiment.
Yeah.
So I believe we're going to need both.
That's quite interesting because someone's saying, is there a correlation between fintech and the stock market?
Well, fintech stands for financial technology, so I think there is a lot of correlation, and that's why we say we're a fintech company that's focusing on the real estate market, and that's where you've got to be careful on this liquidity, because liquidity actually is the correlation then to the stock market.
This is the last one I'm gonna ask you.
Someone's learned how to use Slido, because in Durban and Joburg we had like literally 2 questions.
The question just says, is the internal return shown in the opportunities per annum or over the project duration? So I guess the question is in terms of internal rates of return versus what we call cash on cash.
Yeah. So just ask the question again. So
is the internal return shown in the opportunity per annum, or is it over the project duration?
So it's per annum. So I don't have time today to talk about internal rate of return. We've had a lot of feedback from people that we should use simpler things like ROI, return on investment. The problem is that wealthy people invest in property using internal rate of return. So the bottom line is, should we make it simple, or should we use what wealthy people are doing and help people to become wealthy? Because I can, quite frankly, bullshit you and say the return's 70%. But if it's over 3 years, it's not 70%, because you've got to divide it by 3 at least, and then you should take inflation and time, blah, 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 blah. Do you see what I mean? So if it's a 17% internal rate of return, that's taking into account 27 variables, but most importantly, it's giving you your return per year so that you can compare it with the bank account. nature can't change. So like gravity, if I drop this thing, like there's a law of nature unless you go to UCT. Now for me, what's important is that we wanted to build a company based on nature's laws. So a bird flying in a flock can fly 70% further than a bird flying on its own. But there's ways in terms of how those birds fly together. When the ones in the front get tired, they go in and they look after each other. It's not one bird wins and all the other birds die. 20th century thinking, yes or no? Really, it's a big, if I'd had my way, we would still have our logo with the lack of birds in it, but everyone that knows about marketing said it was terrible. So, but this is our principle of where we came from. And, you think about the animals going across the savannah, the birds swimming in the flocks. There's a lot we can learn from nature. So in terms of partnering, for those people, that already have, extensive networks and, have clientele, this again is completely transparent. So if you come along to us and say, I've got a database of people, but don't tell anyone, we're not interested. But if you've got a respected network of people who respect your opinion and you want to share it with other people, we use Salesforce, it's called Channel Partners. Melanie's actually here. Did you mind just standing up?
Stand up.
So Melanie's there. She actually runs this fully for us. So all I will say about it is that if you want to share this with people, we can actually track it, and you've got complete transparency of what's happening. And there's a very simple monetization model. It's built, it's transparent for everyone, including all the investors. Clients and as investors, and they became what they call design partners. Today it's the 14th biggest company in the world, technology company. And not only did the community help build a great system, but they all benefited in winning on the upside as well. So for us, when we sat back, we were like, well, that's a pretty cool story. If we're really going to follow nature's laws and we're going to work together, why don't we create the community? So I'll talk about that after lunch if people are keen, but that's really what our wealth partner program is. And Willem's going to talk a lot about industries and disrupting them. Do you know that the real estate industry is, other than the prostitution industry, is probably the one that's changed the least in the last 2,000 years? Although Willem's going to talk about the prostitution industry is going to change as well. It's quite an interesting industry that's ripe for disruption. And that's really what our wealth partners are, but we'll talk about that after lunch. So I want to leave you with one thought. It'll take me 2 minutes. For me, when you look at the world, there are literally 49% of the world's wealth is held in property, real estate. And yet less than 12.9% of people on this planet have access to real estate. Most of you in this room are able to sit in this room because your parents or someone that was close to you had access to property. And the wealth effect of that property is how you basically are part of the middle class, at least. Is that fair? What's astounding to me is that of that 12.9%, in the Western world, so not in South Africa, in the Western world, less than 1% of us will retire wealthy at 65. So we're all going to work our butts off. We're going to pay our taxes. We're going to do everything we were told to do. And 99% of us are going to fail. So my final question for the morning is, what is a family office? Anyone want to venture a guess what a family office is? Yeah?
It's like a fund or whatever where they don't invest public money, they just manage their own money. So like a hedge fund that instead of using public money, they're investing their own money and growing their own, they're like their staff and
So it's exactly, you're right. So effectively, they're just looking after one family, though. And in simple terms, what they're doing for that family is that they are looking, so if it's Villy's family, they're looking at Villy and his family and exactly what their bespoke needs are. And then they're looking across the world for the opportunities, and they're just marrying the two together, and they're creating generational wealth. Is that fair? And so the question I ask everyone is, why is that not possible? This afternoon, you're going to hear about all the technology. Why is it not possible that we can literally personalize for you, search the world for the information, use systems like GIDS, and help people make the right investments for themselves? Why is it not possible? Because I think it is. And when you look at it, there's my wife and son. This is literally 6 months ago. He was playing Global Monopoly. And at a very young age, he's learning that to own green hotels and red houses and earn passive income is what they call smart investing. With an amazing team, we've literally turned the game of Monopoly into real life. This is my portfolio, a mixture of residential and commercial across 4 continents and currencies. It's literally what I believe we call smart investing. what Kevin was talking about is two things when you walk out. I don't have one on me, but there's vouchers for everybody, 100 Rand voucher. And my great friend from UCT said, what's the catch? It's the same catch as Uber. When they gave you that first free ride, they knew you'd never catch a yellow taxi again. Exactly the same catch. We just want people to go on the platform. It's why we actually have this prize. So you can win an apartment in that building worth 2.5 million Rand. And all you have to do is sign up on the platform. Yep.
So, just to get this straight, you don't charge a membership fee or you don't charge an upfront when joining the platform, you don't even charge on the transaction. Is that right?
Couldn't have said it better myself. No, it's perfect. There's no fees. This is not a, that's it. So you're 100% right. So the platform is yours to go and learn and see. And so I'm conscious of the time. For me, those 4 things that we started off this morning, don't lose money. That's why we spend all the time with Vili. Asymmetric risk reward. I fundamentally believe with technology now that we can. Tax efficiency. We didn't have time today to go into this in detail, but we've got lots of webinars and stuff where we have. And actually, Lo, our CFO, is here. He loves public speaking, so if I got him up front, he would kill me. But if anyone is serious and wants to talk tax, actually today would be a great opportunity with Lo being here. And then diversification, hopefully, I think we've hopefully covered that, in terms of where we're at. So that was my purpose to achieve today. And really, in conclusion, I just wanted to say there's a deep gratitude. So thank you very much. I know your time is extremely valuable. If you're coming back after lunch, I would highly recommend it because Willem is one of the more sophisticated people in this space, and he's going to share with you the stuff that you literally would battle to learn in America, and yet he's doing it here. And really, I think it's incredibly valuable. But from our side, I just want a deep gratitude because your time is very valuable for us, but we also like to share where the world's going. And hopefully today, if nothing else, we've enlightened you a little bit. So thank you.
Just a reminder that, as I said at the beginning, in terms of if you are very hungry and you want to go to Slug and Lettuce there, we have ended late. So there is only 50 minutes. We will start at 2 o'clock so that we don't run too late this evening. So, yeah, please do that. Just some of the other questions here. Someone said they're not on Facebook, so how will they get all the links? Who's not on Facebook? So
it's actually, no, you know what's actually really interesting? Everyone laughs about not being on Facebook, but most 20-year-olds and less are not on Facebook.
Sorry, these aren't on Snapchat.
It's just important, we laugh about not being on Facebook, and the 16-year-olds laughing at us for being on Facebook,
Yeah.
but that's a separate
We
topic.
will actually send out the link. You don't actually need to be a member of Facebook in order to actually see the links.
So,
You can get them. In terms of this afternoon, it won't be live streamed, unfortunately. And in terms of the last question asking, is the targeted return the hurdle rate for the performance fees?
So every project has a hurdle
Yes.
rate. So whatever project you're getting into, it has a hurdle rate, so you know. So whether it's 8 or 11%, you know exactly what it is before it starts. And that's if it's 8 or 11, whatever, the very first 11 goes to the investor, and then after that is where, but it's clear upfront. Is that fair?
Yeah.
So there's not one across the whole thing, it's per project.